Yes, Joanne, thank you for coming. You're the special guest. You're the lead financial planner for the PREC planners, and you're going to tell us all about the personal real estate corporation, what we need to know.
Awesome. Let's do it. Okay, I'm going to share my screen. And just so everyone on the call knows, throughout this entire presentation, I will be sharing my screen. I toggle between a document camera and the PowerPoint, but sometimes when I toggle between the two devices, it doesn't share. So if at any point I'm presenting and you don't see something I'm sharing, can someone please just speak up? I once did an entire 45-minute presentation where I thought I was sharing my screen and I was not. No one said anything. So please do that. And I like to keep things very casual, very friendly. I welcome commentary or feedback. I'm doing this for you to get as much out of it as you possibly can. So feel free to interrupt and ask questions as we go. It makes it a lot more interesting when it's not just me talking for an hour. So right now, today's session is called PREC Now What? Unlocking the Power of Your PREC. And so I'm sure there's some people on the call that do not currently have a corporation and are wondering when they should incorporate or not. So we'll absolutely touch on that as well. Before I get into it, the standard disclaimer. Anything that we say or talk about here today is meant to be high-level education only. Okay, I'm not making any recommendations. I'm not telling you to do anything. But if something I say piques your interest, please feel free to reach out to your own accountant, lawyer, financial advisor. You're welcome to book a complimentary one-on-one with me after as well, and I can, get into your details and see if I can help you. And I believe this is being recorded. So today is Wednesday, February 25th, 2026. So if you're watching this at some point in the future, just know that tax and financial planning laws may have changed between today and whenever you're watching this, so take what I say with a grain of salt. And a big thank you. Like you said, TO put this together. There's a lot of work that goes into this. I'm always really appreciative of the brokerages that, invest back into their teams and are looking to provide education and are open to having us in. So big thank you to the leadership at Century 21 Millennium for having us and coordinating to put this on. So nice to meet you. I won't spend a ton of time here. So my name's Joanne Martin. I'm a certified financial planner. I've been doing this for almost 10 years. And prior to this, I was a mortgage broker. So I made the shift from doing mortgages to financial advising. I knew some real estate agents, and so they became clients at that time. And that was long before you could incorporate your business. So when the PRECs came on the scene in 2020, my existing clients were like, Joe, what is this PREC? Should I do it? Should I not? What do they mean? How does this work? And so I just kind of by default landed on this niche market. So I dug in, learned everything about Prex. And then they were like, you're really good at explaining this. Would you come talk to my office? Would you talk to my friend? And it just sort of ballooned to the point where in 2024, I launched the Prec Planners brand. So I do have another branch of my firm where I deal with non-real estate agents and where my former clients sit, but I spend 95% of my time in this space now. So I'm on a mission to improve financial literacy for real estate professionals, and I travel all over Ontario and work with brokerages and real estate boards. And this is what we do. I've got a great team. I've got a full-time office administrator. We do manage investments. I'm tri-licensed to investments and insurance as well. So everything's kind of on the website, and we're growing and, real estate agents. And then that's the other brand. So again, if you have clients or whatever that you think could benefit from planning help, we do have another branch of the firm that does that. Okay, so before I get into Prex, it's really important to understand who the different professionals are in your life, okay? So sometimes people would say, oh, I don't need a financial planner, I have an accountant, and we do very different things. So the best way I can explain an accountant is there's someone that is backwards facing. They're really looking at historical data. What did you do last year? What did you do the year before? Give me all your information, and I'm just going to file your taxes and keep you compliant with the CRA. It's a very transactional relationship. There is a small percentage of accountants that will do forward-facing tax planning, but that's definitely the exception, not the norm. So most people get frustrated with their accountant because like, well, why didn't my accountant tell me this? And I would assume that my accountant would have thought of that. And that's just not what accountants do. Okay, they're really there to keep you compliant with the CRA and file your taxes. I'll talk a little bit about bookkeepers later on in the presentation around the corporation, but essentially, I know most real estate agents, especially before they incorporate their business, DIY their bookkeeping. Okay, so I'm going to talk about the importance of having good bookkeeping practices once we incorporate in a bit, but your bookkeeper is really there to give accurate data to the accountant. So the accountant just takes whatever data you give them and they file your taxes. In my world, the word financial advisor and financial planner are different. So the word advisor, there's no real governing legislation about who can be a financial advisor. A mortgage broker could be a financial advisor. It's kind of not a loosey-goosey term, but no one's really governing it. And most people associate financial advisor with investment management, right? How many of you have an advisor at the bank? You meet with them every 1 to 3 years. They put you in the BMO balanced fund and you top up your RSPs and we carry on. And that's really the advisor role. What I do as a planner, and the word planner is protected. So you have to have certain designations to be able to call yourself a planner, is we do forward facing work. So I would say, okay, where is Christina at today? What are all her numbers today? And what are those going to roll out over the next 5 years, 10 years, 40 years? How's she going to exit the business? What are the risks and opportunities here? We're going to look at cash flow, estates, tax planning. So I work with the accountant. So it's not one or the other. We do very, very different things. Does that kind of help? And the other part I'll say too is for those of you that are on the cusp maybe of incorporating your business or you have already incorporated your business, know that the professionals you have in your life will probably change as your business elevates. So the same accountant, bookkeeper, and financial advisor that got you to where you're at in your business before you formed your PREC, there's a good chance that they're going to change once you become an incorporated business owner. Not most financial advisors don't know anything about corporate planning or corporate investing. Some accountants don't even really do corporate tax returns. So it's not an insult or anything like that. It's just the same professionals that you had in your life pre-corporation may not be the same professionals you bring forward. Fair enough? Questions, comments on that? Good. All right, so now I'm going to share and switch. We're going to go over to my camera and let's get right into this. All right, I will autofocus this in a second here. 1 second. All right, so before we talk about PRECs, we have to talk about kind of what your life looks like. Everyone can see this okay? Yep, perfect. Your life with no PREC. So you're out there, hopefully making a bunch of money selling houses, and it's all coming to you as a person. There is no differentiation between you and your business. From a tax standpoint, from a legal standpoint, you are your business is you. So from a taxes, whether you make 0 to 50K, you're going to have be about a 20% tax rate. Once you start making more than around 235K, you're taxed 54 cents on the dollars. Oh, also too, for this presentation, I'm rounding numbers here. Okay, we're doing general concepts, so there's no decimal places. And this is usually the point in which real estate agents go, ouch, this sucks. Every dollar I make over 235K, I'm spending 54 cents on the dollar to the CRA. How do I get around this? So we'll talk about that. From a savings perspective, again, too, you're kind of limited. We have the RRSP, Registered Retirement Savings Plan, and how these work. 18% of what is called your earned income, and this is an important word to remember for later on when we talk about PRECs, okay, can go into one of these accounts and decrease your taxes for the year. But it maxes out at about 30K per year. So for these agents that are making $300,000, $500,000 a year, okay, great, you can put $30,000 into an RSP and not pay tax on it, but that doesn't deal with the rest of it. So you can end up with these RSPs that are really, really full. The other thing around RSPs, and I'd say with most wealth planning, is very few people focus on, but how do we get the money out later? Everyone focuses on what I would call wealth accumulation, right? How do I get more wealth? How do I get that 10% rate of return? How do I save as much money as possible? And very few people focus on wealth deaccumulation. What's going to happen to this money when I go to withdraw? What are the tax implications when I die? So some things about RSPs that people don't realize is at age 71, the CRA says, hey, Trevor, you've never paid a dime of income tax on this money your entire life. You got to start ponying up. So it's now called a RIF. So it's no longer an RSP. This is just a paperwork change, and it gets converted into a different type of account. And why this is important for real estate agents is you can now no longer contribute. And there are still a lot of real estate agents that are making good money in their 70s, right? You're collecting referral fees, you're selling good house, like even if you're selling 5, 10 deals a year and collecting referral fees, you now have lost this ability to defer some taxes. So you can't contribute anymore. And now there is a minimum you have to withdraw every year. And the minimum is a percentage of the size of the account. So if you have $1 million in your RSP, there's probably about 50 grand that you're going to have to pull towards income that year. I just had a call with an agent this morning at 9 o'clock, and this was her beef. She's like, my RIF minimums are huge. I've got rental income. I've got my PREC. I'm supposed to be taking dividends. And she didn't realize that her RIF minimums were going to be so high because she's got about 1.2 million in that account. The other part about RSPs that people don't realize is what happens to these accounts when you die. On a high level, you never want to die with money in your RSPs. If you have a spouse, no problem. All the money in your RSP can roll over to your spouse tax-free. But if you don't have a spouse or the death of the second spouse, it's as though you did a full account withdrawal the day you died, and it's taxed at your
Joanne,
highest marginal
with me?
tax rate. Go ahead. Yeah.
Yeah.
Oh, was that a question or just someone's mic was off? Okay. Okay. So if you die with $1 million in your RSP and you don't have a spouse, over half of that is going to taxes. So you can have your kids named as a beneficiary. That's fine, and they will benefit from it, but the estate is going to owe the taxes left owing on that. So usually when I talk about RSPs and RIFs with real estate agents, they're really hesitant to withdraw because there's like some stigma like, oh, RSPs are for when I retire. I don't want to pull money out because I'm going to get taxed on it. So a big part of what we do with planning is like, let's focus on making this money out tax efficiently. The last sort of part on the side is we've got the tax-free savings account. These are the most underutilized accounts in Canada. Most people, how many on this call, have one of these accounts at the bank with just some cash sitting in it. You treat it like a savings account. I think if they had been called a tax-free investment account instead of a savings account, people would actually use them properly. On a high level, as long as you were 18 since 2010, since these came out, you have $109,000 you could put into one of these accounts today. You want to invest this money. Okay, and I'd say that's where most people miss out. They just put the money in there and they leave it in cash and they treat it like another savings account. And we want to invest it and we grow it. So let's pretend this is Trevor. He's never opened a TFSA before. He opens ones today. He's got an extra $109,000 lying around and he puts it all in there. We invest it and grow it. And let's say we get it to $250,000. He can withdraw that full 250K. So I'll move my paper up here in one day and pay no tax. And that's the beauty of these. Okay, so he grows it, invests it strategically. He wants to buy a cottage, help kids with the down payment, go on a trip to Vegas, whatever. He can pull it out and pay no tax. But this now becomes his new contribution room that he can put back in there. He just has to wait until January 1st of the following year. So a situation where understanding this helps, I'll give you an example. I had a client whose mother passed away in late 2024. She's going to get a sizable inheritance. It's taken a while for the estate to close. And so about halfway through last year, her mortgage was up for renewal. And she had just over $200,000 in her TFSA. She's done really well with it. And so what we did is we pulled all the money of her TFSA. She paid off her mortgage. And then this year, when the money from the estate comes in, when her mom's estate settles, we're going to refill the TFSA again. So is that going to happen to everybody? No. But I like to say that growing wealth isn't like one trick. It's not a TikTok video. Like, if you just do this one thing, you're all going to be wealthy tomorrow. It's not. It's a series of doing like 5, 10, 15 little things right over the course of your lifetime that adds up to building wealth. And in this case, it saved her from having to renew her mortgage, pay interest on it, wait until the estate came in and all that sort of stuff. So it put her that much further ahead. Okay? The last part on your life. Any questions about RSPs, TFSAs? I know today's not really about that, but it's important to understand because people always ask me about them when we get to PRECs. Good? Okay. So the last part on your life with no PREC is I do want to take a minute and talk about your Canada pension plan and your old age security. Okay? So if there's any new agents on the call or younger agents, if you don't have a corporation, you are 100% contributing to your Canada pension plan. I have some agents that tell me, no, I'm not, I don't contribute. You are. When your accountant says, hey, Tabitha, you owe 40 grand in taxes, there's a portion of that is just going to CPP. So the difference between these is OAS money is based on residency. CPP money is based on contributions. So OAS, as long as you're a resident of Canada, when you turn 65, this money's just going to start coming into your account. Right now, it's about $800 a month. So for the agents on the call that are turning 65 this year or in the next year, why this is important is it kind of auto starts in and you'll be like, sweet, I'll take an extra $800 a month. That's awesome. But it is what's called means tested. So this is truly a social program. It is funded by our taxpayer dollars and is designed to keep seniors out of poverty. So if you're a real estate agent and you're 65 and you're still making really, really good money, sorry, it's a little blurry again there on me. Once you start making more than about 90K of net income in a year, they claw it back 15 cents on the dollar to the point where once you make more than 143K, you get no OAS. So what this means, you turn 65, 800 bucks a month goes into your account. The next year you file your taxes. The CRA goes, oh, hey, Tabitha, we shouldn't have paid that to you. Sorry, not that you're 65, Tabitha, but you're the only person I can see on the screen right now. We shouldn't have paid that to you. You have to give it all back to us. And so I've had a handful of clients that get caught with that they spend it and then they have to pay 20 grand back the following year. So it's always retroactive. Okay. On the CPP side, it's based on contributions, based on how much you work. So when you don't have a PREC, you are considered to be both the employer and the employee of your own business. So you're on the hook to pay both halves. If you had another job working for Home Depot would pay their half of the contributions and you would pay your half. So you're paying both halves. Right now, how much is it? It's a percentage that increases based on income. On a high level, once you make 80K per year, you've put about 9K into CPP and then it stops. So if it doesn't kick in, so depends on how you, so there's a comment there that says Mark Lewis doesn't kick in automatically at 65. It does depend on how you have it set up with your MyCRA. I know that you can apply for it as well. You also can defer your OAS to age 71 and get more later on. If you want to do that though, you have to email the CRA at least 6 months before your 65th birthday, to ask them to defer it. And if you don't, it's a really big mess. Cool. All right. But on the CPP side, once you make 80K a year, you put about $9,000 in a CPP, and that's sort of it. So if you make 300,000 GCI in a year, you're not paying a percentage of all of that into the Canada Pension Plan. It does max out. It's called your year's maximum pensionable earnings. One thing to also note too is these are both taxable sources of income. So again, sometimes people think because it's old age security and it's a social program, you don't have to pay tax on it. That's not true. These get added to your income tax for the year. So with Canada Pension Plan, choosing when you start to collect this money really depends. So every single person on this call is going to get a different amount from CPP because it's based on how much you worked over the course of your lifetime. So you're a good little Canadian at age 18, you get your job and you start contributing, and every year you're making money. At age 60, the CRA is going to send you a letter in the mail that says, hey, Christina, if you want to start collecting your CPP today, you can. We don't really want you to do that. So we're going to give you 36% less than what you're entitled to. And how much you get is just based on the percentage of all the years that you spent working in that time frame. So every single person's CPP amount is going to be different. Does that make sense? If you defer it to as late as age 71, they do like that, and you'll get 42% more. So most people, basic math, would go, I'd rather 42% more of a number than 36% less than a number. But remember, it's taxable income. And where some people get caught with this is what else happens at age 71, your RIF minimums kick on. So especially for real estate agents that are still working, 65 is kind of the break-even point. So for those agents that are still working between 65 and 70, oftentimes they will defer it because I still have my income coming in, my rental income coming in, I'm going to put this off. But then at age 71, you have to take it. And this can be thousands of dollars a month difference, depending on how old you are and how much you've contributed. These are some really big numbers that can be in here. And then once these are turned on and your RIF minimums are turned on, you can't, actuarial tables are your friend. Yeah. How it is. So how do we choose when to start our CPP? It really depends. There is no right answer. And I will always say, when it comes to financial planning, if you're ever talking to a financial advisor that uses words like always or never, don't listen to them. It is such an individual decision based on things like household income, whether you have a spouse, whether you have kids, what your sources of income. And I've made recommendations on both ends of the spectrum to start it early, to start at 65, and to defer to age 71. One of the factors around CPP is longevity. Some people, if they don't want to do the math and they don't want to get into actuarial tables or hire a planner or do the work, and they're like, I don't know, I just want to make sure I get back everything that I put into it. Because remember, this is your money, right? You've been putting your money into this every year. High level, break even. If you collected at age 65 and you think you'll live to age 80, you'll get all your money back, like roughly. So if your whole goal with CPP is just to make sure you get your money back, that's kind of what you can do with it. From a longevity standpoint, that's a good segue into what happens to your Canada Pension Plan when you die. So on the old age security standpoint, there is no death benefits. If you die and You don't collect your OAS. It just goes. You don't, your spouse doesn't get anything. It's just kind of there. On the CPP side, if you die with a spouse, they will get topped up to whatever their maximum should have been. So again, everyone has a calculation that they're going to qualify for. And then there's a maximum they could have gotten over their lifetime. No Canadian ever qualifies to get the maximum, so they'll get topped up to their maximum. But if they're already at or close to their maximum, they don't get anything from yours. So when I do estate planning for couples, and I would say, hey, Trevor, what would your spouse do if you passed away prematurely? And you would say, oh, well, they would have my CPP and they would have my OS and they'd have my rental income and they'd have all this sort of stuff. That might not necessarily be accurate. So we just want to make sure that those needs are met at the various points in life. If you die and you've contributed to CPP all your life and you don't have a spouse, your estate will get a one-time fee of $2,500. That is it. Taxable income. So if you hear, so CPP it's not a scam. It is very well funded. Sometimes I'll talk to younger agents. They're like, I don't want to put in a CPP. There's not going to be any money there for me when I go to use it. That's not true. It's one of the best managed pension funds in the world. It has $650 billion in this account. If you've contributed to CPP, your CPP amounts will be there for you. Um, and largely because this math doesn't usually work out in most people's favor, right? Most people pass away before they ever collect all the money that they put into it. But it's great for people who have longevity because it's indexed to inflation. So it's a good paycheck. If you want to live to be 102 years old, this money is going to keep coming in. Cool. I think I missed some stuff in the chat. Just let me check real quick. And then we'll get into PRECs. Chat. The house always wins. Yeah, especially with pension stuff. Okay. Any questions about sort of your life with no PREC? Not meant to be depressing, but it just sort of sets the stage as to why we might incorporate our business. So now let's bring.
I got a quick question, Joanne, if that's
Yes,
okay.
absolutely.
Insurance policies and using those as, I guess, funding pools,
Yeah.
other kind of tax shelters.
Inside the corporation, yeah, I'm going to talk about that.
Okay, cool.
Awesome. Just on the personal side or in the PREC? Or both?
No, on a personal side.
Yeah. So, I mean, that's a product you can put in place. There's different. I'm going to talk about them inside the corporation, and then everything I say there will also apply personally as well. Is that cool? Whoever asked that? Sorry, I can't see you.
Yeah, that's good. Thanks.
Okay, perfect. So let's talk about PRECs. PREC stands for Personal Real Estate Corporation. And the challenge I'd say that most agents have in the first year or so that they incorporate their business is you're now two separate people from a tax and liability standpoint. So you're still up here as an agent making money selling houses, but you also have a role as a shareholder of a corporation. And these are separate people from a tax and legal obligation. So just think of it this way. As an agent, you have a SIN number, and your PREC has a BIN number, a business identification number, and they both have to file taxes separately from one another. And I'll talk about when you would form a PREC or not, give me a second, but the costs of having a corporation, you're going to pay a one-time lawyer fee of about $2,500 to set this structure up. What I will say, please do not use your real estate lawyer for this, okay? Get a business lawyer. Real estate law and business law are different, and there are certain what are called shareholder restrictions that are specific to PRECs that don't apply to other corporations. And I've seen it a handful of times, and I'm sure maybe even at the brokerage where the agent's just real estate lawyer says, hey, Tabitha, you send me a bunch of deals. No problem. I'll form your PREC for you for $500. And then they set it up and they don't get the shareholder structure right. And it costs you a bunch more money to fix it later. Okay. Ongoing, you're going to have to pay your lawyer about $300 to $500 a year to keep what's called your minute book up to date. Please do this when you get audited. And I say when, because you will get audited at some point. The CRA is going to ask to see your minute book. And if you haven't done this every year, then you're going to have to pay your lawyer a lot of money to go back and update it on an emergency basis. So just kind of get used to doing that when you file your corporate taxes. From an accountant standpoint, you're going to pay them about $3,000 per year to file your corporate taxes. It doesn't matter how much the PREC makes. If the PREC makes no money or tons of money, just the basic corporate tax filing is going to be about $3,000 a year. This price can go up if you have salaries coming out of there, if you've got investments with T3 slips. But it's going to start around $3,000 a year. I'm going to take 2 minutes and talk about bookkeeping. Like I said earlier, most real estate agents DIY their bookkeeping, right? You've made a cute little Excel sheet on your computer that you tell yourself you're going to keep up to date, and you're really good at bookkeeping when it's slow between November and February, and it's the first thing that you drop once things get busy, or you tell yourself you get to it on the weekend, and then you never actually do, and at the end of the year, you kind of throw a bunch of stuff together and just hope it's good enough. Corporations are held to a higher standard of bookkeeping called GAAP, the generally approved accounting principles. You have to generate financial statements, your profit and loss statements. And if you don't get a bookkeeper to do this, your accountant's going to do it, and the accountants charge like $400 or $500 an hour to get this done. Bookkeepers are $40 to $50 an hour, so just cheaper to have a bookkeeper do it. The other part of having a bookkeeper is when you get audited. So if you're new to having a corporation, there's a lot of agents right now that incorporated in 2021 that are starting to get audited now. They let them run for about 4 or 5 years, and then they'll reach out and they'll say, hey, Shay, show us all your meals and entertainment receipts from 2021. And if Shay has a bookkeeper, they're going to say, no problem, here's my bookkeeper. I've got houses to sell. Let me know if you need anything. If Shay does not have a bookkeeper, they go, oh, shoot, 2021, what did I claim on meals and entertainment? Where are those receipts? I have them in an envelope at home. Oh, but they're faded. Oh, I got to upload them. What do I do? And your business is kind of ground to a halt. And the CRA just wants the information they want when they want it. Okay? So it just becomes this professional thing. And what happens is when they see that you're DIYing your bookkeeping, then the CRA goes, there's probably some stuff here that's not right. And then they won't just look at your meals and entertainment, they'll audit your whole practice. And say in that scenario, Shay cannot produce the meals and entertainment receipts that match what they claimed. The CRA will say, no, that's not allowed. We disallow the entire category, and you'll go back and pay all the penalties and interest that would have accrued from 2021 until now. So it's very, very expensive to not have proper bookkeeping once you incorporate. I mean, it's on the sole proprietor side, it is as well. They don't care quite as much on the sole proprietor side as once you incorporate your business. Okay, so we've got this all set up. How this works, so you set up your corporation, you go to TO at the office and you say, hey, stop paying me. Please put my commission checks into a corporate bank account. So this is also something you're going to have to open. So now your commission checks go in here. Let's pretend you make $250K GCI in a year. You've got $50,000 in expenses that your bookkeeper did for you, and you need another $100,000 to fund your lifestyle. And I'll talk about that in a second, right? You've got groceries to buy and vacations to go on and mortgages to pay. This leaves you with $100,000 left over that's unaccounted for. So there's a question here in the chat that says, can you use credit card statements instead of receipts? No. So say meals and entertainment, for example, on the credit card statement, it will just say Moxie's for $125. You took a client out for lunch. But what if that was HST? What if that was tip? What if that was liquor and food? And who was the client that you went with? So that's all the information that they need to see on the actual receipt. Now, can you go to the credit card company and request that? My accountant says that they can dig into it and do if they want. But again, every time you got to go back and do this, people charge money for it, right? Your accountant's gonna be like, yeah, I'll do this work for you, but I'm going to charge you $500 an hour to do it. So no, your credit card statements are not a substitute for having the physical receipt with all the different items that you purchased. Same as a gas receipt. For all they know, great, you went to the Shell gas station and spent $80, but did you buy cigarettes and lotto tickets or did you buy gas for your car? So that's why you need the actual itemized receipt. Cool? All right. So you're left with $100,000 left over. This is what is called a retained earning. So if anyone's ever heard that heard those words before, that's what they mean. It's earning that your corporation has made that has just been retained inside the corporation. And this is what is taxed at 12%. And that's why people incorporate their business. Because as you saw over here, if you made $250K after you paid your expenses, and your lifestyle, like you were just taxed between 40 and 54%. Whereas if you have money left over that you can leave in something owned by the corporation, it's only taxed at 12%. Which is a good segue into, Joe, when should I incorporate my business? I would say most agents incorporate their business too soon. You only want to incorporate your business once you're going to have retained earnings. So whatever you make, minus your operating expenses, which should be about 25% of your GCI, minus your lifestyle, if you have money left over, it might be time to incorporate your business. It's not how much GCI you make. I know some agents that make 600K GCI and they should not have a corporation because they spend $600,000. I know some agents that only make 50K GCI, but they have other sources of income because they work part-time as a teacher, they've got rental income, their spouse makes really good money. So the $50,000 they make from real estate, they don't need it. It can all just stay in the corporation at 12% tax rate. So it's not how much you make, it's how much you need to fund your lifestyle. And I'm happy to walk through people with that on a one-on-one basis to help them figure this out. I would also say, please do not incorporate your business until you have some personal savings. If you still have unused RSP room, use that first. It's more tax efficient than a corporation. Make sure you have some money in a TFSA. Make sure you have some money in a personal bank account, that personal debts are paid down a little bit, because once your money's in a corporation, it's kind of stuck in a corporation. So the next thing I'm going to talk about two things. I'm going to talk about what we do with these retained earnings, and I'm going to talk about how we get money out of the corporation. So let's go here first. So this $100,000 you need to fund your lifestyle. How do we get it out? You have some choices. You can pay yourself as though you're an employee of your own business. This is called taking a salary. This is going to give you T4 income. You're going to contribute to CPP, and you're going to get that RSP contribution room. Like, it's just like you went out, got a job somewhere, you're on payroll, you've negotiated a rate of pay with yourself, and you're paying yourself. The benefit of this is now an expense to the corporation. So it decreases the corporate taxes owing. So that's one of the benefits of being on a salary. The other benefit of being on a salary is our world kind of runs on T4 income, right? If you want to get a loan for a car or qualify for a mortgage or any of that sort of stuff, people just go, what's your T4 income? Eventually, you can use other sources of income, but for the most part, the world revolves on T4 income. So if there's younger agents on this call that haven't bought your first home yet, or you're saving up to buy your first home, there's other accounts we can use to shelter your tax, like your first home savings account, your RSP, before incorporating your business, because then this makes it tougher to qualify to buy for things, depending on how you pay yourself. The other way you can pay yourself is as though you're a shareholder of your own corporation. Okay, so this is called taking a dividend. This is going to give you T5 income. And this is the important part. This is not earned income from a tax definition standpoint. And I know you're like, but Joe, I earned that income. I busted my butt. I sold those houses. I put up with those clients. I earned the income. And that is true. But if you elect to pay yourself as a dividend, the CRA views it as you just happen to own shares of a profitable corporation. So no different than if you went out and bought shares in Bank of Nova Scotia, and Bank of Nova Scotia paid you a dividend. You just earned some dividend income. You didn't go and work for Bank of Nova Scotia. You just happen to own shares of a profitable company. And so because it's not earned income, there is no CPP contributions and there is no RSP room that's generated. From a tax perspective, which one is most beneficial? Doesn't matter. The income tax was rewritten around 2012 under the rules of what's called integration. And it's designed so that whether a business owner pays themselves a dividend or a salary, it's going to come out to about the same net amount of tax paid. And if you want to go and Google what are the dividend tax rates of a Canadian controlled private corporation, this is much lower, but you have to pay the 12% corporate tax rate first. So whatever this dividend tax rate is, the corporation's paid 12%. There are some, again, I'm oversimplifying a little bit, but the reason to choose salary over dividend is not tax savings. It's what are you trying to achieve? Okay? Any questions about how we pay ourselves? You can do a mix of both. What I would usually recommend is for most sort of younger agents, younger than age 60, do a base salary, max out that CPP, get those for savings, and then top up with dividends. If you have really good savings discipline, you could go on an all dividend and save that CPP for yourself and invest it, which we'll talk about in a second. But I'd say that's what most agents end up doing is they do like a base salary and then take dividends as needed to top it up. All right. Now let's talk about these retained earnings. So you've got 100 grand left over at the end of the year. You pay your 12% corporate taxes. Now we have to do what's called corporate investing. So you've got $88,000. What are we going to do with it? I'd say the majority of agents just have this money sitting in cash because they've been busy. They've been selling houses. They don't know what to do with it. That's just the lady I talked to on the phone this morning has $1.1 million in cash in her corporate bank account because no one's talked to her that she could do anything else with it. So we want to invest it. So one of the ways we can invest it is through what I would call traditional investing. So you go to a firm like myself or the bank or your advisor and you open up a corporate investment account. It is owned by your PREC. Pick your investment product of choice. ETFs, mutual funds, stocks, bonds, whatever it is, you open up the account, you put those investments in it, and you invest it. A couple things to know about traditional investing inside of a corporation is it is different than the RSP or TFSA. So all the money that's in these accounts, because they're tax sheltered, it doesn't really matter what products we put in there because there's no tax implications. But this is what's called a non-registered account, and the growth is taxable. So there's 3 ways that we make money when we invest. One is through what's generating interest income. So products that generate interest income is something like a GIC, a high interest savings account, bonds, private mortgages. I know lots of agents like to do private mortgages. So these all generate interest, right? People get that. You go buy a GIC, we'll give you a 4% interest rate when it comes up for renewal. This is taxed at 50%. So if you buy, Tabitha's face just kind of dropped there. Okay. If you don't know what else to do with your core investments and you went to the bank and they say, what do they do? They say, oh, just buy a GIC with it. And you're okay, I'll get 4% rate of return. What's going to happen is you're going to get a T3 slip when that GIC comes up for renewal, and you're going to have to pay a 50% tax rate on it. So the net rate of return on interest-bearing products, not great inside of a corporation. The second way we can make money is through capital gains, right? So this is, you buy a stock, you buy a mutual fund, you then later sell it, hopefully for more money than what you bought it for. That triggers a capital gain. The tax rate is the same as on the personal side. 50% is tax-free, and then the other 50% is taxed at the capital gain corporate tax rate. So this is good. Yay, smiley face. So we want to focus on products that generate capital gains. The third way is through generating dividends. So again, owning stocks, mutual funds. There are even some ETFs now that will pay dividends. That's the other thing too. I know ETFs are a really big thing. They have their time and place, not opposed to them at all. They're great, but just any index ETFs are generally going to generate interest income. So understanding how these different products are taxed is really important. So dividends, also great. You'll get a T3 slip, get taxed at dividend tax rate. You can get money moved out to you personally. So high level, focus on products that generate capital gain and dividend income. So that's one way we can grow our money inside of the corporation. You can use your PREC to buy properties. How this is going to work is if you need a mortgage to buy the property, the mortgage lender is going to recommend, and they'll probably only lend to you, if you put your money in something called a holding company. So the PREC is what's considered an operating company, right? It's actively operating as a business. Lenders do not like to lend to operating companies because if the operating company gets sued and their asset is stuck inside the operating company, their asset is then subject to that liability. So they're going to make you make a holding company. You can move money from the PREC corporation to the holding company, and then we're going to buy our houses over here. That's totally fine. Just please note that your rental income there is interest income, and you're going to have to pay tax on that as well. So you can buy properties with it. The other thing is we can put life insurance inside these policies, inside the corporations. So in this situation, there's different. So you can put term insurance here, you can put whole life, participating. There's all different insurance products we can put in here. But please know that your corporation can own a life insurance policy. So I forget who was asking about that. Was that you, Mark? Or I don't know who was asking about it. So how these work is depend on the life insurance policy. The policy goes inside the corporation. The corporation pays the premiums, and you're the life insured, and the corporation owns the policy. We put the money in there, and depending on how you structure the policy, that money is invested. That money invested inside the corporation grows tax-free. Is the only way to grow your money tax-free inside of a corporation. It's a little bit more complicated than that. I'm really oversimplifying it. And depending on what life insurance advisor you speak to, some really, really aggressively promote and structure these. I have life insurance license. I absolutely love the strategy and the right time and place for the right person. But just please note that if you're just talking to like your buddy that's a Sun Life rep or a Manulife rep, and they're not looking at your whole bigger picture, you're probably going to end up put too much money into these policies. So just know you can take some of this money, put it into life insurance. While it's invested in there, it's growing tax-free. That's great. And what happens is when you die, all the money pays out inside the corporation, which creates something called capital dividend account room, which allows it moves out to your personal estate tax-free. I have a whole session I do called Insurance in Your PREC. I just did it 2 weeks ago, and I'll probably do it again a little bit later in the spring, where I dig really into the details on how these policies work and how the structure. But just if you want to talk about this or you think this might apply to you, please just like reach out and I'll happily go through some of the pitfalls and how these work. The other thing we can put in here is critical illness insurance. So same sort of concept. Corporation owns the policy. The agent is the person that's insured. We can put what's called a return of premium rider on here that says if you don't ever make a claim, you get 100% of your money back after 15 years. So those are fantastic. I think that every single real estate agent that is self-employed should have one of these policies inside of their corporation with the return of premium. It's just part of our responsibility of being self-employed to protect our income. You do have $25,000 of critical illness coverage through the Ontario Realtors Wellness Program. You could opt for more, but just so you know, you do have that. But it's a nice way to get really good coverage, forced savings, guaranteed to get your money back, and have your corporation pay for it. Okay? One of the questions I usually get around this stage in the game is, I have a personally owned policy that I'm already paying for. Can I move it inside my corporation? Right, Joe, I qualified for this 10 years ago when I was younger. I like the rate. I'd rather my corporation pay for it than having to take money out to pay the premiums personally. The answer is yes and no. Depending on who you talk to, again, if it's just a life insurance qualified person, they'll be like, oh, no problem, Tabitha. We're going to do a change of ownership form. Boom, your PREC now owns it. But it's not like what Mark said. You need an actuarial assessment because this is a personal asset that has a value. Even a term policy has an actuarial value, and technically your PREC has to purchase it from you at fair market value. So they can be moved into the corporation. It is, if something ever sounds too good to be true or too easy to be true, it probably is. So please just stay on side and don't just start transferring all these personal assets inside of the corporation. Okay? That's kind of it I have on this side. My next thing is to go over, I've got 2 case studies that I kind of walk through about how this sort of comes together. But before I switch my screen off of here, is there any, that's a really busy piece of paper. Does anyone have any questions or comments before I get into the case studies?
I feel like I have to do some tweaks to my planning because all I keep seeing is die, die, die. I have a spouse, so yeah, I don't have to make a pact with anyone to get married by the age of 70. But yeah, great. Love this session.
Okay, that's good. I know. And every time I write that, I'm just like, oh, like I don't want people to leave these calls and be like, and now I'm depressed. Like it's not. It's just this is supposed to be empowering. Like, okay, at least you figure it now. I always feel bad when people reach out to me and they're in their late 60s, early 70s, and they're like, how do I fix this now? And our opportunities to, I mean, we still can put some things in place, but just the runway becomes shorter. So that's sort of the extent of it. Yeah, no, nobody's dying. It's okay. All right, let's go back to my screen. All right, I think we're back. Trevor, you can see my PowerPoint okay?
Looks great.
Yeah,
Cute guy. Yeah.
Totally just stole that off the internet. Nobody rat me out. Okay. Oh, actually here, I'm going to show you how we actually work. So before I get into the case studies, I'll explain to you how I work with my clients. Where can we find this video at the later time? Tabitha, I'm going to reach out to Tio. Your brokerage is recording this, so I don't know how they're going to share it with you. So on my website, I've created something called a planning program, and that's what we do. It's 5 phases. You hire us, you pay a one-time planning fee, which I'll show you in 1 second, and we go through it all. Janet, I'll answer that question in 1 second. So the first phase, which is not populating right here, is called Learn and List. We get on a call. Where are you at? What have you got going on? Can I even help you? Take all your information. If you want to go ahead, then we get you a letter of engagement, privacy agreement, disclosure agreement, invoice, and we get to work. We give you a link to your own Teams folder and say, hey, Trevor, upload all your documents in here. You drag and drop. We give you a list of everything we need. Then the second meeting, we get on a call, and we do what's called assess and audit. So I built your net worth sheet. So we're going to go through that line by line and do a deep dive. Trevor, talk to me about this investment property. Talk to me about your primary residence. Do you love it? Do you hate it? You're going to downsize. Talk to me about your kids. Talk to me about your current financial advisor, because we'll see all your statements. Do you like them? Are you happy with what's going on there? And I know my company's called the PREC planners. I'd say half the people we work with do not have corporations. So, and the plans I do is for your whole house and family. So it's not just the business, it's all the personal stuff as well. We're gonna go through your risk tolerance, confirm your questions, problems, and goals. Then I take all that information, I go back to my team, and we start building your plan. So we use a really robust planning software called Conquest, and I'll put all your information in, project it forward. So then I get on a call and I say, hey, Trevor, I built your plan. Let me present it to you. We log into the plan software live together, and I show you exactly how I came to the recommendations that I did. So I'll type up notes. So if Trevor had a question for me about, should I own life insurance in my corporation? Should I pay myself a salary or a dividend? Should I move my personally owned real estate into a holding company? Like whatever it is your questions you have, we will answer those. But where we provide the most value is we will also highlight any gaps, risks, or opportunities that you may not have thought of. Like you just don't know what you don't know, right? So I'll answer your questions, but also say, you should also probably think about this, Trevor. And we'll do that. So we do a full investment insurance portfolio comparison of what you currently have. So we'll explain, most people don't know what they're invested in. They don't know what the fees are. They don't know what the diversification is. They don't even know what's going on. So we'll give you a breakdown of that. And then if it's good, green light, carry on. Don't change anything. And if it's not, then we can work with you to get that done. Phase 4 is then called act and implement. So great, you have your plan, but there's no point in going through all this process if you just print it off and put it on your shelf and never look at it again. So we got to actually start doing some stuff about it. And this is going to look different for each client. This might be opening those investment accounts and rebalancing portfolios. It might be working with your accountant or a lawyer to get that PREC set up, get your bookkeeping set up. Your PREC needs its own will. Most people don't know that as well. It's a separate entity from you. It doesn't necessarily fall under your personal will. It needs its own will. So whatever it is you need, we're just going to be there to support you and make sure you get done whatever it is you need to get done. I joke I kind of become people's mothers and just like politely nag you to do the things that are good for you. And then phase 5 is called monitor and move. So at this point, if you just want to take our recommendations and go back to your existing team and implement them, go for it. You've paid us for your time. You can keep working with whoever you like to work with. If you want us to step in and continue to be your long-term partner, then your investments can move over to us and we can get your portfolios going and whatever it is you wanted to. And then we have like a full service agreement. I do quarterly touch points for all my real estate agents. We keep that plan up to date. We'll continue to service everything and that sort of it. So how do we get paid? And I'm pretty transparent. Everything is on my website. So if you do not have a PREC for those sole proprietors, we charge $2,500 plus HST. It's one time, and it's good for a full year after your plan's delivered. And that includes what's called an incorporation readiness analysis. So if you're that agent, just like, oh, my accountant say I should form a PREC, but I don't really know, but like this, and maybe when do I or whatnot. So it includes a full household financial, up to 3 rental properties. We'll do business and personal cash flow, net worth statement, and all the things we talked about. Insurance, investing, CPP, OAS, retirement planning, pension analysis. I find a lot of agents have previous pensions, right? Your former teachers, former government workers, for whatever. So should I LIRA my stuff out? Should I take my commuted value? What does that work? So we'll do those pension analysis. If you do have a PREC, then we charge $3,000 plus HST. It includes everything that's over here in the foundation plan plus the corporation. So we'll do that salary versus dividend compensation strategy. We'll work with your accountant if you need us to. We'll talk about, how do we do income splitting from the corporation later on. That estate planning piece. And again, collaboration with the accountant and lawyers needed. We don't charge any extra for that. And we look at all these other strategies that I didn't really talk about today, like health spending accounts, charitable giving, and that sort of part. So that's kind of the extent. That's how we work. Cool. All right. Back to the slides. So case study number 1. Good. 10 minutes left. So Leo and Lori. So in that first phase 1 learn and list meeting, what have they got going on? So Leo, when I met him, was 58. He's been an agent for about 15 years, and he was planning on working for another 5 years at the time. Likes what he does. Has no debt. He had taken about $150K off the HELOC on his home to do a private mortgage. And he's been a client now for 4 years, and this is sort of a running joke because when I first met him, it was going to be coming back in 3 months, and it's been 4.5 years and it still hasn't come back. So I know a lot of agents that end up in situations like that. That's fine. He's on a team, does about $600K a year GCI. He's half of that. Taxes paid up to date, and he had just formed his PREC. This was in 2021. And his accountant told him to take $12K a month from the PREC. And this is how the conversation with the accountant. Leo, how much money do you need? And he goes, I don't know, 12K a month, because that's what he was made when he was a sole proprietor. And so they 10K for Leo as a salary and 2K for his wife. So his wife is a couple years older than him, and she retired during COVID from healthcare. She took a reduced pension. So they have 3 daughters, and so the daughters are at the stage where they're getting married and they're starting to have grandbabies, and their daughters all live really close to them. And so she wanted to be that stay-at-home grandma and help out. And they're really, really big on family. So that was like a top priority for them, for her to be able to just be there for her daughters and their grandkids. Wasn't collecting CPP or TFSA's full, and she had a bit of unused RSP room, but most of it was in her pension. So this is why they hired us. One was they keep getting the letters about the CPP. They didn't know she's 63. Does she take it early? Does she defer it? He's got a corporation now. How, like, they just didn't know what to do. And at the time, as I said, I think he had about $250,000, $300,000 in a corporate bank account. So he's like, I got 300K in the bank. That's probably not a good thing. What do I do with this? And then he started asking about retiring. Like, he really likes what he does, but now that the grandkids are on the scene and there's more other things to do, like, he's like, no, maybe I want to retire this year. But he had no idea. He's like, am I going to be stuck selling houses till I'm 80? Or can I quit? Like, he had really no concept about what this looked like for him. And he had just, and this kind of what triggered it, he had just filed his corporate taxes and he was really mad because he's like, I feel like I just paid just as much tax as I did before I got my PREC. And now I also had this like $6,000 accounting bill, like, and all this other stuff. So he was actually really quite upset. So no problem, hired us, gave us all his documents. We get into our phase 2 assess and audit meeting. And when I actually start seeing what I has, he had investments all over the place. He had stuff with like Raymond James, Fidelity, CIBC. He had some old Sun Life investments that he had even forgotten about. And same as the insurance, he had like a policy with Cooperators. He had a policy with Empire Life. And it was just, none of it was synced. And same as the insurance, a lot of it was from when his girls were still little. He had a big term 20 policy that he was still paying for, but he just didn't, he was just paying for it. He kind of even forgotten about it, right? It's just one of those automatic payments that comes out and he didn't even really know about it. And when we actually talked about his cash flow, he really only needs about 6K a month. He's a pretty minimalist guy. Um, there's no cottage, there's no rentals. They like to do a little bit of travel once in a while. So he's pulling 12K a month from a corporation and now it's just sitting in his personal bank account. And he really only needs 6K a month. The other thing we uncovered is he's a man of faith and he believes in giving 10% of his income back to the church every month. And that was about $600 a month. That, again, totally fine, but there's some planning work that can be done here. So what did we recommend to Leo and Lori? So in phase 3, plan and present, what I told them, I was like, stop taking 12 grand a month from the PREC. You don't need it. We can invest inside the corporation instead. You don't need to be paying your wife from the corporation. You don't need it. We can pull from these other buckets. In her case, we did tell her to start her CPP early. And the reasoning behind that was she's a breast cancer survivor. And so she had some concerns around longevity and deferring it. So we're like, you know what? This is $800 a month you could pull now. And that's less you have to pull from the PREC. And at least you're collecting it. So we made that decision. I got him all new portfolios. We transferred everything over, cleaned it up. We got his corporate investment account going. And then what we ended up doing with life insurance was we put so we canceled the term that he just really didn't need anymore. And it was about to renew anyways and go up. So we put a policy inside the corporation. And I said, would the church rather they get $600 a month now for the rest of your life, or just while you're still working? Or would they rather they get like 1.5 million when you die? What makes sense? And so we ended up putting that $600 a month into a permanent policy inside the corporation. And on his dual will of the corporation, when he passes away, the proceeds of that policy will go to the church. So now he doesn't have to pull it from his PREC and pay taxes on it. It's going to move out of the corporation tax-free. Pennies on the dollar, the life insurance is, and we did a little bit more so it can offset some of the taxes. And the church is still going to give just as much money. And he has that flexibility. So to go back, whose question was it around? What is your advice on borrowing against a life insurance policy as income later in life? I don't love it, Janet. Sorry, not Janice. So with some of these policies, they build up and have cash value in them. So there's an investment component, and some advisors really aggressively saying you can now leverage this to borrow later in life. It's absolutely an option. I like building plans that have as much flexibility in them as possible. I would not bank your retirement plan on doing that. They're not as tax efficient as people make them out to be, and they can go sideways. So as a complement to maybe your income stream later in life, sure. Throwing all of your retained earnings into a policy and it now being your pension later in life, absolutely not. That's my personal philosophy, and I can show you reasons for that. Okay, so just that. So this was like a pretty simple plan, right? There's no investment properties here. There's no holding companies. There's no multiple corporations. This is a pretty simple plan. We just shifted where the money was coming from in some different buckets, and it saved him about 35 grand a year in taxes. And I said, he's been a client now for 4 years, and fantastic. Last case study. Sorry, one more question in the chat. Do you work with mortgage agents too, asking for a friend? Yeah, for sure. And I know there's a lot of real estate agents that are dual licensed and have mortgages and real estate as well. So talking about should you put your mortgage commissions through the PREC or not, or should your mortgage business be incorporated and not have a PREC or whatever it is? Yeah, Chris, that's not a problem. Case study number 2, Sharon. This is a really common scenario. She's 67, single, been doing this for 20 years, and she has 2 adult sons that are both licensed real estate agents as well and work in the business with her. As a team, they do 350K GCI. She is honestly 80% of that. Her sons don't sell a ton. She wasn't collecting CPP, and her big stress is she has no other sources of income. So she doesn't have a spouse. There's no previous pension income. Like whatever she has, like she's fully on the hook for making sure that she survives through retirement. She does have one investment property. This was during COVID. It was in red, right? Variable rates. You know how investment properties that went into the red during COVID. RSP was maxed out at only 500K, and that's one of her questions. It wasn't growing, and she didn't really have much going on with her TFSA. And she did form a PREC, and she had about 250K in the bank. So no personal debt other than the mortgage on the investment property, and she was working with someone at CIBC. So this is why she hired us. She wasn't confident with investments. So she has $500,000 in RSP. She's like, Joe, it's been there for 10 years. I swear it hasn't grown. Like I go in, I meet with the guy at CIBC. He's lovely. He's really nice. He kind of talks over my head. I don't really know what he's saying. And she was just like, I'm a really smart businesswoman, but I don't get this. And I need someone to explain this to me. And it wasn't working. That's because she wasn't confident with investing, and she wasn't confident to ask the questions to know how to become confident with investing, if that makes sense. And then she's like, when can I retire? She's like, I'm 67. She's like, I love what I do, but she's like, I would love to know that there is a date in which I could go where I don't have to answer the phone anymore. That's really what she wanted. She's like, when can I turn the phone off? And then the same thing too, how should she be paying herself? So she incorporates her business. She actually has the same accountant as Leo. She sat down and he said, how do you want me to pay you, salary or dividend? And she was like, I don't know, you're the accountant. Shouldn't you tell me? And most accountants fall in either team salary or team dividend, just for whatever reason. But she's like, I feel dumb. She's like, I pay these guys like a lot of money, and I feel like they should give me some consultation, and I don't even know what we decided or what I'm doing. And then this conversation around her son. So her ones, they're both licensed. One works full-time in the business with her. One has another full-time job, but the one that has a full-time job actually sells more houses than the one that works full-time in the business with her. So she was really struggling here with the family dynamics about how to pay everybody, how to do splits, how to save, how to take care of herself. And then we obviously really get to know our clients really well. We have a conversation around her granddaughter, and she's like, Joe, I've done more than enough for my boys over the course of their life. If anything were to happen to me, I need to make sure that my granddaughter is taken care of. So that's sort of what we ran with. So phase 2, assess and audit. She gets us all of our documents. When she uploads all her insurance policies, she was paying about 15 grand a year in a whole bunch of different policies. She's like the nicest woman in the world. And I swear every time she went to a networking event and she sat next to a Sun Life rep, she would just buy another policy. So she didn't even know what she had or what she should keep, but she was so scared to cancel them. And cash flow, in her case, she's actually spending more than she thought. Verbally to me, oh, I don't spend much. I stay home. I don't travel. But then once you actually get to know her and see her lifestyle, which is fine. We just have to make sure that the plan can support that. And so what was happening with her investments at CIBC is I think there was a bit of ageism going on. They just saw her coming in as a senior single woman. So she was all in cash and GICs. That's why her money wasn't growing. So just the way she was ticking those boxes on that investor profile, because she didn't know what she was doing, she just was in all these GICs that weren't doing anything. So it wasn't really invested according to her true tolerance and her goals. So what we told her to do, I was like, you need to stop taking money from the corporation, and we're going to start pulling money from your RSPs instead. She hated this idea because in her mind, pulling money from your RSPs is what old people do. And she was like, I'm not old. I don't want to pull from my RSPs. And I was like, but from a tax perspective, this is really smart because if you drop dead tomorrow, half your RSPs are gone to taxes, where the money in the corporation, we can give the shares of the corporation to your granddaughter in a trust. She was like, oh. So we're going to do that first. We did tell her to start her CPP. And I said, if you need more than this threshold that we did the calculation on the RSPs, we'll just do a little dividend from the PREC to top up for vacations or whatever. We got her new portfolios, moved that money over, got that corporate money invested. And even though she was a bit old, she was 69 by the time we actually did the policy, but she's super fit and healthy. We put the policy in the corporation. She kept two of the policies because they were really good and they were going to be running out when she was 70 anyway. So we're like, just keep those ones. And just doing that, that's even with her being older and getting new policies, it still saved her about $8,000 a year in premiums. And we did get an RESP going for her granddaughter. So she was really happy about that. So she's saving every month for her granddaughter's education. I have met with both of her sons twice, to varying degrees of success. I am good. I am not a miracle worker. So we're just going to kind of keep working away at that estate. And it's an ongoing conversation and we'll see how that goes. But I think she just values having someone to chat with. So that's kind of the extent of it. Look, finish 1201 right on the button. That's my email address. That's my phone number. I have a Calendly link. You're welcome to, if we send me an email, I'm happy to send it to you. I'm always happy just to chat and see if I can help or whatever you need. Well, that's kind of it. Anything else? We're a pretty quiet crowd for people that started off really chatty at the beginning.
We are on the edge of our seats. It's like watching an exciting movie. This was, I think I speak for everybody. This was such a refreshing way to communicate, such a at times stressful for agents, for anybody. So Joanne, excellent job, and kudos to you. Kudos to Teodora introducing us to Joanne and walking us through this, and kudos to Christina for organizing these incredible training sessions that we do on a weekly basis. So I'm just feeling the love right now. But as far as your presentation, a lot of information. I've recorded this session for everybody. I'll be posting it on our little YouTube channel, and we can post that out for everybody. I'll give the video as well to Christina, and we can repurpose that if you're okay with that, Joanne, of course.
I'm fine. Yeah, I've done this session literally hundreds of times. I think it's in every broker's training dashboard. It's totally cool. And just so I don't know if I can get people's email addresses or if you can send them to me after. So I do a newsletter once a month. And so I'm always offering different education sessions. Like I said, I have one on just investing. I have one on just insurance. I have one on retiring with the PREC. I did a whole tax series with 5 different accountants last fall. So just make sure I get everyone's email addresses because that's where like those one-off sort of things. I don't spam people. It's once a month. And it's just like, if you want to know more, this is where I'll be.
Yeah,
Cool.
I think we can do that. And I think, I mean, I'll chat with
Thanks,
Theo and Christina afterwards, but we'd love to have you back. I mean, we're entering into a timely part of the year where taxes are now the big conversation and how we're preparing. And at the very last minute, like, oh, we're getting our books together. So no, this is great time, and you're a great communicator. So thanks so much,
Awesome.
Joanne.
All right. Thanks, everybody. Like I said, just
you.
send me an email. We'll stay in touch. And I'd happy to come back about anything else at some point in the future. Okay?